Good evening and welcome to the third session of our winter term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Centre for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I'm Dr. Juan Castañeda, Director of the Institute, and today we'll be hosting Professor David Llewellyn. David is Professor of Money and Banking at Loughborough University. He has previously worked as an economist with Unilever in Rotterdam, the Treasury in London, and the International Monetary Fund in Washington, D.C. He has wide experience in financial regulation, both as an academic researcher and also as a practitioner, having been a public interest director of the Personal Investment Authority, one of the predecessors regulatory agencies of the Financial Services Authority, and more recently, he has been the chair of the banking stakeholder group of the European Banking Authority. He has written and researched extensively in the field of banking and financial regulation, including the inaugural occasional paper of the Financial Services Authority, The Economic Rationale of Financial Regulation and Supervision. He has also been a consultant to several regulatory agencies in the UK and abroad. Today, we'll discuss whether the regulation pendulum has swung too far in the banking industry, after which we will allow time for Q&A with viewers at home. Today's presentation is being recorded and it will be made available on our YouTube channel very soon. And your questions must be submitted via the Q&A option on Zoom, and I will moderate the questions and address the speaker at the end of the presentation. So thank you so much, David, for accepting our invitation. We are very much looking forward to listening to your presentation, and then perhaps we can have questions from the audience. Thank you.
Joanne, thank you very much indeed. Can you hear me okay?
Everything is fine.
Yeah, that's fine. Well, thank you very much indeed for your kind introduction and also for the opportunity to exchange a few ideas that I have based on both my research, but also my practical experience that you outlined. I should add at the beginning that this is not a clearly defined paper as such, but it does draw on various other papers that I've written, including one recently with Tim Congdon. So there's going to be no statistical testing, but what I'd like to do is a few reflections and conclusions based both on my research and also on the practical experience. As you say, I worked with the PIA and the banking stakeholder group, and I just want to draw a few lessons. And my main conclusion is, in answer to the question in the title of the presentation, is yes, the pendulum has swung too far. So a few opening observations. There is indeed a pendulum in regulation. It does swing over time, over decades, with varying degrees of intensity and complexity as far as regulation of banks is concerned. In other words, there seems to be no steady state in the degree of intensity of regulation. I think there are three reasons for that. One is that I'm sure everyone is familiar with the availability heuristic, that we tend to assign a higher value to recently experienced episodes compared with the longer run. And in other words, when there's been something of a crisis or something's gone wrong in the financial system, we immediately react to it and very often overreact to it. So there's no doubt that one of the reasons why we now have a very high degree of intensity of bank regulation is because of the availability heuristic, the experience of the 2008-9 banking crisis. There are also changes in political and economic ideology that we're all familiar with, but also I would add there's a process of bargaining, and particularly in periods of intense regulation, bankers do try to bargain with the regulators. So that's the first point on the context. What we've had is one of the biggest ever banking crises has produced the biggest ever change in bank regulation since 2009. To the extent that what seems to have happened is that our previous faith in markets has now given way to faith in regulation. And I believe that is a mistake. We also know from our experience of the last crisis that we had no adequate resolution arrangements before 2009. By resolution, I mean, and we'll discuss this in more detail later on, by resolution, I mean, how do you actually deal with failing or failed banks? Believe it or not, we had no special arrangements prior to 2009. So in other words, at the time of the crisis, we had no special arrangements how to deal with failing banks. In that situation, I argue, in that bullet point there, bailouts are inevitable. However, as Mervyn King has observed, we've in the process created one of the biggest moral hazards in history. That must change. The problem is governments always say that there will be no bailouts. And the reason being, of course, is because if markets and everyone believes there will be a bailout to a failed market, to a failed bank, the moral hazard is that banks start behaving in a particular way that increases the probability of them failing. So we had no credibility because there was no adequate resolution arrangements. There was no credibility in the statements. There will be no bailouts. And I will argue later on that the only way to ensure credibility of the no bailout strategy is if the social costs of bank failures can be reduced very substantially. My final point of open context is, what exactly are we trying to optimize? And I would suggest it is what I'm going to call the regulatory regime. Just now, in a few bullet points, just summarize what my basic conclusions are. I'm not sure how far we'll get with all of them, but if I try to give you the big picture first, and then we'll go into a little bit more detail in some of them as we go along. So just following the bullet points on the screen, I would believe now that we need to focus on what I call the regulatory regime. And this is based on what I've defined as objective 1 and objective 2 of the regulatory regime. Objective 1 is to reduce the probability of banks failing. That's where regulation comes in. But objective 2, which I think is equally important, is what can we do to reduce the social or systemic costs of those banks that do fail. It doesn't matter how detailed we go in objective 1, reducing the probability of banks to fail, there will always be failures. We could, I think, conceivably imagine a structure of regulation that guaranteed that no bank would ever go bust. I think that could be done. What you would then have is a completely useless banking system, because you would have regulated away the risk-taking that we require banks to undertake. So given that there always will be bank failures, we do need to also look at objective 2, which is how to reduce the social costs and systemic costs of those banks that do fail. Second point is that the whole methodology of regulation, in my view, produces over-regulation. It's almost an inevitable part of the process. I'll come back to that in just a moment. We have a lot of pressures towards over-regulation, which produces what we call disproportionality, a degree of regulation which is far more intensive, far more complex, far more detailed than is actually necessary to achieve its objectives. And as part of that over-regulation, I believe a major component is that regulation has become far too complex. My next bullet point here is the trade-off between objective 1 and objective 2. And my argument there is that the more you can lower the social costs of bank failures, objective 2, the less we need be concerned about regulation for objective 1. So I think one of the reasons why we have over-regulation is because we have not done enough with regard to objective 2, lowering the costs of those banks that do fail. Then in answer to the question, what are we trying to optimize? Answer, the regulatory regime. We're not trying to optimize regulation. It's a relationship between objectives 1 and objective 2. For that to happen, we need credible bank resolution arrangements, how to deal with failing banks. There will be, and we also need to have credibility in the no bailout strategy. This can be achieved, our next bullet point, if the social costs of failure are significantly reduced. As part of all of this, there needs to be major reform of the way that cost-benefit analysis is conducted. And if I may just give you a hint of what's to come, my major criticism of the way cost-benefit analysis is conducted is that it is too micro. It looks at each individual regulation, applies some form of cost-benefit analysis to that, and that particular regulation may well pass the standards of cost-benefit analysis. What we haven't done is to do cost-benefit analysis on the totality of regulation. So we could easily have a situation where each and every individual regulation passes a cost-benefit criteria, but the totality is over-regulation. My final 2 points is that the banking crisis, in my view, was a failure of supervision, both by supervisory agencies and markets, rather than a failure of regulation. So I would say it wasn't that regulation failed, but supervision did. And as a result of that, I think we need to put much more focus needed on market solutions, a partnership between markets and supervisory agencies. So that's just to repeat what I mean by the regulatory regime. Objective 1, lowering the probability of bank failure. Objective 2, lowering the social, and I should also add systemic costs of bank failures, especially to taxpayers. What we actually found, of course, in the last crisis is, in effect, the taxpayer became the insurer of last resort, but it was on the basis of a very bad insurance contract. In other words, there was no ex-ante insurance contract. It was like me going along to an insurance company when my house is burnt down and say, could you please compensate me for my house burning down? Oh, but by the way, I didn't ever pay any insurance premiums. You may try that if you wish. I can tell you the answer that you'll get from your insurance company. But that's in effect what happened with the bailouts in the banking crisis, or following the banking crisis. Therefore, the optimal regulation for objective 1, which in the past has been the only objective that we've had, the optimal regulation for objective 1 is indeterminate until we have dealt with objective 2. Because how much regulation you need for objective 1 will be determined by how much you can reduce the costs of those bank failures that do actually occur. In other words, we need a holistic approach. My criticism of the past has been we've had incremental overregulation, because we haven't spent enough time, in fact, very little effort, on how to reduce the social costs of those banks that do fail. I said at the beginning that one of the reasons for overregulation, or one of the reasons why the pendulum has swung too far, is because of the way that regulation is actually conducted. And I call this, if you like, the methodology of regulation. That may not be a very nice term, but there we are. That's what I've called it. And it has the following points to it, summarized in the slide. I regard regulators basically as the suppliers of regulation. The trouble is that regulation is not supplied through a market process. That means that regulation has a cost, there's certainly no doubt about that, but because it's not provided through a market process, it doesn't have a price. And I think we all need to be a little bit careful about any activity that has a cost, but not a price. There's a lot of information. The big danger is it's perceived as a free good. Because we don't pay for regulation in the form of an explicit price, providing there is anything greater than zero benefit to that regulation, we're going to vote for it. If it's a free good, why not? Providing it's giving some benefit, let's have it. And therefore, because although it has a cost but no price, it's going to be over-demanded. All free goods are over-demanded. Now, if you combine that with risk-averse regulators, and regulators naturally are risk-averse, why? Because of what I've called in various papers the PMV principle, that when things go wrong, a bank fails or behaves badly, it's a lot of publicity, it's measurable, and it's visible. And therefore, regulation is likely to be oversupplied. Well, you don't need to have a PhD in economics to argue that if something is going to be over-demanded and also oversupplied, then you're going to get too much of it. Therefore, my conclusion at this point is that there is something almost inherent in the nature of the way regulation is conducted, that you're going to get disproportionality, too much of it. Well, I'm not going to go through that because time is pressing. The nature of the costs, well, as we all know, there are indeed substantial costs attached to regulation, compliance costs, economics costs, the moral hazard costs, and so on and so forth. We don't need to go into that. Everyone knows that there are costs to regulation, and they are quite detailed. I want to come now to this issue of proportionality. I may slightly rephrase the title of the presentation tonight. I said, has the pendulum swung too far? Let me put it a different way. Has bank regulation become disproportionate? Has the principle of proportionality become infringed? And my answer is definitely yes. A simple definition of proportionality was given by the Treasury in a consultation document only in February of this year, and that's on the screen. It's a fairly obvious definition. A little bit more detail, again, taken from the same Treasury document. I quote the Treasury document because, after all, it's really saying that there is at least recognition that the principle of proportionality should be followed. My argument is that it just isn't. So no need to go through those 3 points. I think they're fairly straightforward if you've had time to read them. One of my central themes is that there is almost an inevitable tendency towards overregulation. a few reasons for that. One is, I've already argued, the availability heuristic. We tend to focus too much. We tend to give too high a value to the most recent experience that we've observed. Hence, very detailed regulation now following the last banking crisis. The methodology of regulation, well, I've just discussed that in the previous slide. It's going to be over-demanded and oversupplied. The endogeneity problem, I'll come to that in the next slide, but the other aspect of overregulation is because cost-benefit analysis that is conducted tends to focus on individual regulations rather than the totality. And as I argued before, you can have a situation where each and every one detailed regulation satisfies a cost-benefit criteria, but when you put the whole lot together, the total is the total costs are greater than the sum of the individual parts. What I call the endogeneity problem, which again, referring to the previous slide, is one of the factors producing overregulation. There's a symbiotic relationship between regulation and bank business models. Bank business models are endogenous to the regulatory regime. After all, banks develop their strategies within the context of the prevailing regulation. But equally, regulation is endogenous to business models, that regulation responds to the way that banks are actually behaving. So the net result is that regulators and supervisors are always shooting at a moving target. And the target is moving because of regulation itself. So you've got this sort of constant interaction between the way banks will behave, then that's followed by regulation, regulatory arbitrage, banks then start changing their behavior, regulation adapts to that. You don't need much of an imagination to work out that that can produce what I've called regulatory escalation. You just get more and more. And so the final bullet point there, in other words, the principle of proportionality is compromised. Just a simple little diagram to illustrate, I think, a major aspect of this, that you get diminishing returns from more and more regulation. So what I've done there is that the total benefits of regulation rise quite sharply from zero, but then fairly soon, quickly begin to slow down quite. The marginal benefit gets smaller and smaller. But of course, as we add more and more regulation, the total costs of regulation continue to go up. So my theme there is diminishing returns to further regulation. When I was chairman of the banking stakeholder group, we conducted a major study on proportionality, and it was actually called Proportionality in Banking, not exactly a sophisticated title. It is available to you. In fact, any of the papers that I'm drawing my material from, if you'd like to get in touch with me, I'll be more than happy to send them to you, at least those who in the audience who may be masochistic. What we did with our study is that we identified 5 pillars of proportionality. And this study looked at the theory, but also a whole series of case studies demonstrating that proportionality, or if you like, excess regulation, was the order of the day. That was what has actually emerged. This study was conducted, I think, about 4 years ago. Look, the 5 pillars that we identified, the objectives, well, what we were saying there is very often the objectives of regulation are not entirely clear. that and particularly in terms of conducting a cost-benefit analysis, has it adequately identified what the market failure is? And does this particular regulation that we're going to introduce actually address that market failure? Time and again, we have found that there's some sort of market failure, regulation has responded, but it doesn't actually address the problem. I've already mentioned the second point, the micro versus totality, that we don't do cost-benefit analysis of the total amount of regulation. We only look at it as at each individual regulation. Almost inevitably, we have excess complexity. I just want to just slightly qualify that. Somebody criticized our report by saying, well, you complain about complexity of regulation, but banking is complex. Well, we have two responses to that. First of all, we are talking about excess complexity. And secondly, it doesn't follow, and this is something that the Andy Haldane argued, it doesn't follow that the best solution to a complex problem is a complex solution. It's very often the case that the best way to deal with a complex problem is actually a fairly simple solution. We also argued there was substantial disproportionality in terms of the failure to make sufficient differentiations between different types of banking firm. It's a one-size-fits-all, and yet we do know that different banks have different have different business models. Their risk profiles are quite different. And we find several case studies where that differentiation was not made. We treated all banks the same, even though they were not prone to the same degree of risk. Materiality, well, let's leave that one because time is pressing. Excess complexity is just as important as having just too much regulation. It increases the cost of compliance. It is a particular burden on small banks because there are large fixed costs attached to regulation. It can create entry barriers. We have case studies where firms have not entered particular types of business because the regulations of that particular aspect has become too complex. It also creates what we've called a box-ticking culture, that there is a tendency when you have very detailed and very complex regulation, there is a tendency for compliance officers and banks just to box tick. Let's just make sure that we can satisfy that particular requirement without actually thinking, does it actually solve the problem that that regulation was designed to solve? We also find we get more chance of regulatory arbitrage. This was found in various studies in the United States, that the more complex regulation is, the more gaming of regulation you're likely to get. Can we now finally come to objective 2? And I hope at the end it'll all come together. One of the major problems running up to the crisis is that we had no clear resolution regime up until 2009. In other words, it was not clear, how do we actually handle a failing or failed bank? In practice, all that the Bank of England could do, or the Treasury could do, was to apply normal bankruptcy law. That is the law that applies to any company that fails or becomes insolvent. Two problems with that. Banking is different, and therefore the normal procedures of bankruptcy law probably wouldn't be very efficient in dealing with banking compared with commercial industrial company. Secondly, the problem is that the normal bankruptcy law is very time consuming. It takes a long time. The problem with banks that are near to failing or have failed, you have to act very quickly. And when I say quickly, often over the weekend. This was changed in 2009, so we now have various special resolution regime, similarly in the European Union. So my conclusion here is that we didn't have resolution regime before the crisis. We have got something of that now. It's yet to be tested, and I'm not actually totally confident that the resolution regime will work as good as the Treasury and the Bank of England think it will. There are problems when you don't have a resolution model. It creates a lot of uncertainty and unpredictability. There's a great temptation, as we found, for forbearance and bailouts. It leaves you then get the time consistency problem, that if you fail one bank, then the argument is that the market then believes that any other bank that fails under the same circumstances will also be bailed out, and that creates the moral hazard. And there's no credibility in the no bailout strategy. The government say there will be no bailout, but without a clearly defined resolution regime, which specifies how you will deal with a failed bank, then that no bailout strategy will not be credible. So what's the purpose of the resolution regime? What do we want in my objective 2? First, we want to allow banks to fail without systemic costs. As I've said, unless you want a degree of regulation that reduces the probability of bank failures to 0, and we certainly would never ever want that, then you're going to get bank failures. Therefore, we have to accept that as a fact. But what objective 2 is, and designed for the resolution to solve, is how can we allow those bank failures to occur without systemic social costs? We also want a regime that adds credibility to the no bailout strategy, and also a regime which enhances the incentive for shareholder monitoring. Just a few bullet points about what the regulatory regime may look like, and there's only a few here. There has to be credible resolution arrangements, bail-in rather than bail-out, and in particular, I think that a credible resolution regime would mean that bondholders, or at least some bondholders, would have to bail in to equity. In other words, that bondholders, under certain circumstances, can be forced to become equity holders. Of course, that will be reflected in the price of bonds. Bondholders, in other words, should also be in a position to lose as well as equity holders. Ring fencing, which has been applied, and I think the main rationale of ring fencing is that it makes resolution easier, in the sense that it makes it easier to close parts of the bank where you're not too much concerned about closure, but keeping alive, particularly the retail side, those parts of the bank that you do want to save. This can also be achieved by what we call living wills, or sometimes called recovery and resolution regime. And this is where the Bank of England now requires, or the PCA rather, requires all banks to have living wills. And in particular, as far as the resolution aspect of it is concerned, these statements have to make it clear, to make it easy, how different parts of the bank that's failing can be dealt with. I also put as a question mark taxation. And I put a question mark because I have mixed feelings about it. But there is a case for arguing that if banks, for whatever reason, would be rescued, or parts of a bank would be rescued if they get into trouble, then perhaps that means the taxpayer becomes the insurer of last resort, in which case insurance premiums ought to be paid, except it would be through the form of taxation. And I think there is a case for having special tax regime for banks as a form of ex-ante insurance premium, because the system may require some banks to be rescued if they get into trouble. These are the various ways in which the resolution can be made of banks that are getting, individual banks that are getting into trouble. I just mentioned one of those, the bridge bank, very common in the United States. The bad bank is another option where you actually take out of the bank the good parts of it and let that continue to run, and manage the bad bank in a special way. That was commonly done in Scandinavia during an earlier banking crisis. In other words, you somehow allow the good parts of a bank to continue and not be compromised by the bad bank. In a way, I think this sums up, perhaps I've been a little bit incoherent, this, I think, sums up a lot of what I've been arguing, that there is possibly a trade-off. I believe there is a trade-off between objectives 1 and 2. And what I'd like to invite you to do is a little thought exercise. Imagine yourself in Alice in Wonderland. Let us suppose, through the various resolution arrangements that might be put in place, let us suppose we could do that so that the social costs of any bank failure were 0. There were no costs attached to a bank failure. I know that's Alice in Wonderland. We won't get there. But let's just think about it. Well, we wouldn't worry about the probability of bank failures. In other words, we wouldn't have to worry about objective 1. There would be no need for bailouts. Why should you bail out a failed bank if the failure has 0 cost? There'd be no taxpayer liability, therefore no moral hazards of bailouts. And of course, there'd be no need for regulation at all. To repeat, that is Alice in Wonderland. But I think it does illustrate the point that there is something of a trade-off, that we have disproportionate regulation for objective 1 because we have not been careful enough with devising good arrangements for objective 2. I said at the beginning that the problem with the banking crisis was a failure of supervision rather than regulation. And I think that I still believe that to be the case, that supervisors need to concentrate on incentive structures within the bank, internal control mechanisms, corporate governance arrangements, the short-termist potential that many bank decision makers are subject to, and the profit-sharing arrangements, where we actually found that decision makers were sharing profits on the basis of very short-term profits and not considering that some of those profits will disappear because of their decisions, because in the long run, that bank is taking too much risk. I'm sorry, it's been a rather extensive presentation, rather superficial. Perhaps we haven't gone into as much detail as I'd like, but I'd rather give the big picture.
Well, David, thank you very much for your presentation. Indeed, very comprehensive. And that's precisely what we needed for the discussion of the topic. So thank you very much for that.
Thank you very much indeed. I've greatly enjoyed it, and thank you for the opportunity. And as I say, if anyone in the audience wants any of the sort of background papers that have influenced my thinking, I'd be more than happy to exchange, to send them along.
Thank you very much again.
Pleasure.
And thank you very much to all the viewers from home.
Yeah.
Bye-bye now.
Thank you. Bye-bye. Bye-bye.
Bye.